One of my favorite quotes is never mistake leverage for genius, right? So it's just because someone got the leverage and the interest rates moving the right way, don't think they're genius. They just took on more risk.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to the show. I'm your host, Todd Dexheimer. With me, I got Drew Whitson again. Drew, how are you doing today?
Hey, Todd, doing great.
I'll give Drew a quick intro for those of you who don't know, but he's my partner with Endurance Capital, Drew Whitson. And he's heading up our acquisitions. Acquisitions are really finance kind of equity side or finance side of the business. So, Drew, welcome back. And the last time we talked a lot about just kind of acquisitions, what's going on in the acquisitions world. But I want to talk today about kind of what's going on with the interest rate world, with the financing world, and then how that is tying to acquisitions. So
Sure.
maybe just dive in, give us a quick overview, and then we'll get into some details.
Yeah. So, right now, sort of in the financing world, it has been interesting to sort of watch the sources of capital, right? And where they're looking to place their capital into the real estate commercial space where we sit. If you were to go sort of rewind the tape 2 or 3 years ago, there was interest rates were low. There was lots of bridge lenders. There was new people getting into the bridge lending space because they could essentially access capital from one account and then lend it out on another account, right? And they'd make a spread. I think I was told, a couple years ago, there might have been 200 bridge lenders, and today there's probably 20. And so that space has really changed as interest rates have gone up, and other sort of financing options have sort of come to the light. There's an interesting thing sort of happening in the marketplace where you have the sort of the Fed, right? The Fed is lowering rates, has signaled they're lowering it maybe one more time in 2025. So there's the floating rate debt on SOFR that's coming down, but at the same time we're seeing U.S. Treasuries go up, right? So depending on where you get your financing, you're either seeing a decrease in the cost of your loans or an
Yeah.
increase, right? So there's this interesting capital sort of play. With Endurus, right? With Endurus, as we have looked back, we have begun to shift our focus as well. The last two deals that we have closed in 2024 have both been fixed long-term debt with major agency lenders. And we've been very fortunate to sort of shift into these spaces where we can buy these assets with a little bit lower leverage and really sort of eliminate some of the financing risk that exists. Where we're trying to take some of that financing risk off the table with our investors. And that's really kind of where we've been in the space we've been working in recently.
Yeah. The nice thing about the permanent debt is that it allows you to sleep well at night. The longer term debt, I guess nothing's permanent, but definitely a longer term debt.
Yeah.
And I even had some investor questions about, hey, if this is only a 5-year term, like what happens in 5 years if the market goes down? And so there still is risk in any type of commercial real estate loan because I guess the only one that's locked in for long term is your HUD loans,
Hmm.
which are really difficult loans to, especially for an acquisition to get. Um,
Yep. Yep.
so, but they're not floating rate, and I think that's the biggest thing that we like. And like you said, we're able to get in a little bit lower leverage, not floating rate.
Sure.
We like that.
Yeah.
These this bridge at 200 down to 20, or that what happened? What's the reason?
Well, I mean, the reason is that no one's modeled, whether the bridge lenders or the banks ever modeled a scenario where interest rates would go up as fast as they did. They essentially went from 0 to 5% in the matter of less than a year in 2022, right? And these kinds of assets, right? Even apartment buildings are generally priced, right? Their value is as a stream of income, right? It's a future stream of income, like a bond, right? And there's an inverse relationship between the value of a bond and interest rates. So as interest rates goes up, the value of bonds go down, right? And the same
Yeah.
thing are true with apartments, right? So the assumption was that you have this very strong asset, right, that was supporting these loans, and interest rates went up. And even if your property's cash flow increased, the value of those assets went down because there's this inverse relationship, right? And so it was the collateralization of these variable rate loans that really started getting adjusted on these bridge lenders' books. All of a sudden, they were lending on something that the loan was worth, the property is underwater, right? It wiped out some of the equity, right? So, in an environment where interest rates are steady, right? It's easy to value assets over the long run. And for many years, when interest rates were low, groups like us didn't really have to worry about interest rates changing because they had stayed low for year after year after
Yep.
year. Um, and now when you have volatility, right, you start having to fight two battles in your deals. One is the executing the operations, the value add, the rent increases, right? Executing your business plan. And then you're also fighting a financing battle. And so for many years, we didn't have to worry about financing battles. We're only worried about the execution of the property. And now that we've seen some volatility, Honduras has adjusted our strategy to say, look, um, no matter what we think is going to happen in the interest rate environment, we just want to stay fixed. And we just want to focus on one battle at a time, which is executing our business plan. And I think it's simpler for us, it's simpler for the investors, and you can't eliminate all risk out of deals, but it allows us to take out the risk where that of the things that we can control.
Yeah. Yeah. I think that's the important part, right? Things that we can control. We can't control what interest rates do. We can certainly predict what interest rates are going to do, but that, you know how that goes. I mean, look,
Hmm.
I've been predicting interest rates and listening to other people's prediction of interest rates since I got into this industry in 2008. And the interest rates were going to go down, and they did go down. But then I can still remember like locking in interest rates at like 5.5%. These lenders being like, that's a great rate. They can't go down from here. And then they went down, and then you'd
Yeah.
lock in another rate at, 5 or 4.75, and they're like, this is the best rate you'll ever see in your life. And they'll never go down. They're going to go up. And then they went down, and then they went
Yep.
down, and then they went down. And they, like you said, they stayed forever. And you started to believe that they could not go up. And that's when it got dangerous, right? That's when it gets bad, is when you're like, they can't go up, they can't go up, they can't go up. And until they do go up. And I remember hearing all, and these are articles by economists, by really smart people, and they really made sense. They had this great thesis about interest rates can't go up, and here's why. I mean, it was going to bankrupt the U.S. if interest rates go up. Like the U.S. can't afford it, so they can't go up. They can only go up. I read some article a while ago that the interest rates can only go up like 200 basis points. That's the max they could ever go up,
Right.
because otherwise they would bankrupt the U.S. And so it's, uh, we're taking that risk off the table, because what we found is that, yeah, the experts can tell you everything, and the reasons why, but they're still not right.
Yeah, I mean, even through 2020, 2021, there was this sort of new theory on sort of global macroeconomics. It was called modern monetary theory, MMT, right? And
Yep.
these were people that said it doesn't matter how much debt we print, it doesn't matter how much the government spend, interest rates will always stay low, right? And so you can Google this, and there was talks and papers, right? This whole new like field of economics that basically said money supply doesn't matter, right? And it doesn't matter until it does. And so you don't hear much from those folks anymore, right? Who sort of paint the reputation on this new modern monetary theory strategy, right? And there was those of us who grew up sort of, became educated and have watched the markets move. And you say it's never different this time, right? It's always the same, right? Incentives drive behavior, right? And if you increase the supply of something, right, the definition of inflation is more money chasing the same amount of goods and services, right? And so, yes, there might have been some lag in demand for goods and services. Yes, as the economy grew and people got more jobs coming out of the great financial crisis, we had some absorption, but it couldn't last forever, right? And so eventually that money, that printing press, chased more. There was more money made than there were goods and services, and therefore prices went up. In order to fight that, you have to bring interest rates up. And so, those of us who had spent time sort of thinking carefully about it, we knew the party couldn't last forever. Right? We knew the
Yep.
party couldn't last forever. Um, and so, yeah, it's sort of amazing how people think maybe it's just different this time, right? It's a new model that exists from here on out, and you can't get away from basic human behavior, and you can't get away from basic economics.
Yep. Yeah, 100%. Now, there's two parts of me that, and this is, I think, where a lot of groups are at right now, is that they say, well, bridge debt makes a lot of sense because we can get this bridge debt and we can, it's flexible. And they're looking at it today. They're saying interest rates are high. They're going to go down. Like interest rates are high today. They're going to go down. And so I'm going to go with this bridge debt while interest rates are high, and then I can either refinance or sell in 3 to 5 years. And then you say, well, what we're looking at is going, well, interest rates certainly feel like they should go down, but
Hmm.
will they? Like they felt like
Right.
they were also gonna, do different things at different times as well, and
Yeah.
they didn't behave as you thought. So we are saying, well, that may be true, but what happens if we bet improperly and we say interest rates will go down in 3 to 5 years? And so we'll buy this property on a bridge or a floating rate. And then in 3 to 5 years, what if interest rates go from where they're at today? Fed funds rate, what is it now, Drew? Like four, right around four and a quarter, somewhere around
Yep.
there.
Correct. Yep. That's right.
Well, what if they're all of a sudden they're at six and a half, seven?
Hmm.
I don't, who knows? Like it sounds crazy to think that like
Yeah.
maybe they would be at seven. Oh, that's stupid. They'll never get there. But I don't, well, maybe
Yeah.
I,
Y-
you would have told me I was crazy. If I told you that in 2021 that Fed funds rates will get up to 5%, you'd have been like, dude, you're so wrong. Like there's no way.
Yeah. I mean, I remember going back and looking at the forward, looking sort of the forward curve, right, is essentially the aggregate, the global aggregate best estimate for where interest rates are going to be over the next 12 to 24 months, right? And we went back in time, even back in 2022 when the rates were first starting to rise, the greatest, most liquid, smartest, banks and never predicted the speed and amount, right? It's staggering how wrong the market was looking forward. And groups that have trillions of dollars on the line making their very best bets were completely wrong, right? So,
Yeah.
and here's really why this matters for our business, right? And it's fun to speculate about interest rates and what might happen. But the fact is that leverage and debt does one thing, right? Leverage magnifies results,
Mm,
right? Leverage magnifies results, whether it's financial leverage or
yeah.
operating leverage, right? And this matters to us, right? Because if you're on a bridge loan and you're willing to take lots in debt and interest rates go down, you look absolutely brilliant. And one of my favorite quotes is never mistake leverage for genius, right? So it's just
Mm.
because someone got the leverage and the interest rates moving the right way, don't think they're genius. They just took on more risk, right? One of the things that I wish our industry would evolve, right? In the real estate industry is not a IRR to our limited partners return because that's what you see marketed, right? Here's a 15% deal, here's an 18% IRR. The real metric, right, that I want our investors and anyone listening to ask is what is the unlevered IRR? What's the return on the deal if it had no debt on it? And that I think really tells you the story when you can compare two deals, right? Because you can have an investor that says, oh, there's a 15% IRR deal and a 17% IRR deal, right? And what you don't understand is how much of that return is being magnified by the amount of leverage, right? Because that 17% IRR just might have taken on a ton of extra leverage and assumptions. What an unlevered IRR does says, let's take this deal and assume we bought it with all cash, right? And so now your
Yeah.
15% and your 17% IRR come down to an unlevered IRR, and that 17 might go to 9, and that 15 might go to 12, right? And so all of a sudden, when you strip out the leverage, you have a risk adjusted return, and you can actually see what these returns look like. And I think that's one of the things that Todd, you and I have had to educate our investors on is to say, look, we are not taking 80, 90% bridge debt on these things. When we bought the two properties we did in 2024, this was at 65% loan to value. So we're using a very low leverage rate and having to sort of communicate with our investors and say, look, our 65% low leverage deal isn't comparable to our, someone else's 80% leverage deal, right? Because they're
Right.
different debt
Totally
structures.
different.
So continuing to educate the investors on how to find risk adjusted. And I think that unlevered IRR really is a helpful metric as one of many ways to do due diligence on deals is to say, what's the unlevered deal, the unlevered return to help understand what risk might you be assuming in these deals.
Yeah, risk doesn't necessarily equal bad. you just have to understand the risk that's involved, right, with it. And it does that risk make sense for what you're looking for too, right?
Correct.
If you're getting into real estate because it's less risk and good returns, well, then go with that 15 IRR. That's a 12 IRR on levered because that's
Right.
what you're looking for. If you're getting into real estate to make as much money as possible, and you're okay with a lot of high risk, and you like the big upside, well, then that 17 might make sense
Sure.
because at 17, it could turn into 25 or 35. It could also turn into zero, but you're
Zero.
okay with that because you have that risk appetite. So I think that's just super important to understand is the delta between. I love that. We by the way, we need to start putting that in our slide decks because that really shows you what this deal is all about. Is this a high risk, high reward deal, or is this a low risk, just good return but low risk deal? And
Right.
if we have a low delta between unlevered and levered, that's a very solid deal, right? But
Yep.
it's also not going to be a deal that's going to get you 40% IRR unless the market goes bonkers, right? But it's just not going to happen. So
Correct. Yeah, and that is one. So when Zach and I, the director of acquisitions for Endurus, when him and I are looking at deals, that is one of the things that we talk about, right? Are we looking at unlevered IRRs that are 8 or 9%? Or are we looking at them that are like 10, 11, or 12, right? And there's less investor education on that. And I think we've tried to do a better job of looking at so for investors, right? There's that unlevered IRR. I also think there should be a composition of the returns, right? If I'm going to double your money in 5 years,
yeah,
does it come 80%
yeah,
from cash flow or 50% from cash flow, or does it come 10% from cash flow, right? So you sort of could think of, this like a pie chart, right? Here's deal A, B, and C. All the deals say they're going to double your money in 5 years, right? Is it 75% cash flow? Is it 20% cash flow? Is it 0% cash flow, right? And there's some great deals at 0% cash flow, right? Because they put a business case together and they can manage the risk. There's some deals, and I think of the deals that we've closed this year in 2024 that are very heavy in operational cash flow as a component of the return, right? It's the reason that our deal that we closed in September, we started doing monthly distributions for the first time ever out of the gate to our investors, right? I think of the deal we closed in December, where we're going to be able to do distributions right away the first quarter of ownership, right? And so I think being able to articulate sort of where that return comes from, whether it's appreciating the value of the property through value add or expense management, or whether it's through just a going concern as a cash flow deal. I think there continues to be nuances to help investors say what sort of risk and time frame and how do I sort of think about that across the sort of the spectrum of offerings in our industry.
yeah, yeah. And that's a huge difference. And that was something it was fun to be able to show investors like, look, that like 60% or greater of your profits are coming from the cash flow. Like we are not relying on the market. I had an investor on this Bretlinger, this last deal that we just closed, that was asking me about, well, you know, so this was a the listeners, this was a mark to market deal, meaning the builder, their job was to build and sell as quickly as possible. So they got to get to 90% so we can get qualified for this deal and we can close on it. Right. And so there's some meat left on it where we can raise the rents. And they said, well, what happens if you can't raise the rents? So I did a quick analysis. What happens if we can't raise the rents? Well, we're still cash flowing really well. Our cash
Hmm.
flow goes from like, almost 7% down to like 6% in year one. So it's still cash flowing really well. Vast majority of our profits still come from cash flow. It brings it from a 17 IRR down to like a 14 or 15 IRR if we can't raise the
Right.
rents at all. And you're
Right.
still going, okay, well, this deal still works. Uh, Now, are we super pumped and excited that we got a 14 IRR? No, we're not as excited. We want that 17, right? But it's still a deal that works. And so
Yep.
I think you got to look at, definitely, risk looks different depending on the deal.
Yep. One of my favorite slides that we get to put out now, and I'm glad we've added this in our last few deals, looks at a grid of like, what if rents don't go up, and what if occupancy goes down? What if when we stress test the financials of these
Yeah.
assets, what occupancy do we need in order to make sure we can at least pay the mortgage, right? And I don't have it in front of me here, but I think it was like 61. Like if we had
So
no
it's,
rent
yeah, like
increases, it's like
63%.
60%,
Yeah.
right? We
Yeah.
could lose more than 40% of our tenant base, never raise rents, and we don't have any risk of losing the asset, right? So it really sort of puts a floor on what how much risk exists in some of these sort of lower leverage deals. And that's a great metric to sort of be able to float to investors is to say, look, a lot of bad things can happen that's outside of our control, but we're not going to have any trouble maintaining the payment on this thing for 5 years, right? And so that's always it's been a great addition to sort of helping our investors understand how to think about these investments.
Yeah. Yeah. By the way, quick side note, don't get confused with real cash flow versus preferred return.
Right.
Um, those are two different things. So real cash flow is the most important thing. That's what
Yep.
you should be looking at. Drew, let's
Right.
talk about interest rates and how they're affecting what's just the market right now. What's going on? What you're seeing in acquisitions, what you're seeing with the debt market, and what's that doing to acquisitions, and what do you see kind of moving forward?
Yeah, so it's been interesting. One of the things that we've been writing into our purchase agreements actually has to do with making sure that the property adjusts for the change in interest rates. So I think of the Bretlinger deal that we just closed. In the deal with the seller, we said, look, as part of the terms of our agreement, this property has to foot to a 65% agency loan.
Yeah.
And as we got closer towards closing over the last 4 to 5, 6 weeks, we actually got a price adjustment. They gave us $250,000 price reduction because interest rates went up and we had to solve for that. So we're starting to see some of that volatility work its way into the agreements, into the purchase agreement. I think there's another deal that you and I are working on here where we originally wrote an offer, this summer when interest rates were a little bit higher. We rewrote another offer this fall when interest rates came down. And now we're renegotiating as interest rates have come back up, right? So I think we've really seen a propensity for both buyers and sellers recognizing that the interest rate volatility drives valuations, and therefore we're willing to make price adjustments both up and down based upon those change in the interest rates, right? So I think that's we all agree that interest rates impact these properties, but now we finally are working closely to say, look, we want to transact this deal. Let's figure out creative ways to sort of memorialize what's going to happen as interest rates change in order to get deals done. And so that's been a really, I think, a great progress from both the buyers and sellers to make sure that deals are getting done
Yeah.
and that neither group is sort of being um, curtailed or sort of at the subject completely at the mercy of interest rates, where we can make this market stay liquid and stay fluid and get deals done and have some way to account for that.
Yeah. Yeah. Are you seeing more deals hitting the market, less deals hitting the market? What are you seeing?
Well, right now I think we're kind of in a holding pattern. That's what we talked about on our last podcast. I do think that now that the Fed has signaled that there will probably be less or fewer interest rate changes in 2025, it sort of smooths out the expectations, which means we can price these properties accordingly. We've got through the election, we've got through the holidays, and so I think 2025, there are going to be a lot of transactions that are going to come up. And now that I think we have a little more confidence that interest rates are going to sort of stay where they are, I think we're going to see a lot of volume come out, and we're going to see a lot of things hit the market. And so we're excited to get to sharpen our pencils and work with our best brokers and work in the best markets that we know and understand, and see what materializes.
Drew, I want to hit on equity really quick, and then we'll wrap up here. But we did, we've done two raises recently, but we also looked at what it would be like to do a deal with some private equity firms.
Yeah.
Let's talk a little bit about that process. You really kind of spearheaded the private equity conversations. Um, what was that like chasing some of these private equity firms, and maybe what'd you learn with the market? What's going on?
Yeah, I mean, Endurus Capital has historically only taken investors through our high net worth investor base, right? We've got a couple groups we've worked with, but at the end of those dollars, our high net worth individuals, the opportunity for us to continue to grow, to do incremental deals, to do larger deals, sits with some of these institutional groups that want to write large checks. A couple of things that surprised me as we sort of took our deals to these
Yeah.
large
Large,
market.
by the way, large meaning like 10 plus $1 million checks.
Well, that was my exact point, right? Is when we needed $10 million of equity, a lot of institutional groups said, that's actually too small for us, right?
Yeah.
They want to write checks for 15, $20 million, right? So even for a group like us, raising 10 million is a big amount. That next hurdle for them is like it's hardly worth spending the time unless they can write a check for $20 million and they can get a property that has 2 or 300 units in it.
Yes.
And so what we've really discovered is there's a big appetite for capital to be deployed into this space. But the deal sizes need to be not 20 or 30 million dollars, but 40 or 50 million dollars. So that was one big learning for us is trying to
Yeah.
sort of realize that there's a lot of capital out there doing the things that we want to help with, but we got to get to their deal size.
Yeah. The market too was a little bit played into a factor too as we looked, this deal was in Louisville, Kentucky, not
Hmm.
a big market, not a small market, but relatively small when you're thinking about, some of the markets in the country. We really eliminated a lot of groups by being in Louisville.
Sure.
You
Yep.
know, yeah,
Yep.
had this been in Dallas or even in Minneapolis, like that would have added a lot more interest in the group. And then, like you said, if we would have been a $20 million check, needed a $20 million check on a 200 unit new apartment building, it would have gotten done.
Sure. Yep. Yeah, I think the other thing we learned too is that there was a lot of capital still chasing deals, even in Louisville, right? Even in sort of the mid-tier size
Yeah,
markets, new construction, but they don't want to be at the very bottom of the capital stack, right? As you think about how you pay for these deals, you have your senior debt, the debt that comes from the agency. And then what we were looking for is one check for the bottom half of it. And most groups said, we love the deal. It's a great market, right? You guys are good operators, but we don't want to take the entire bottom stack. We want to be just behind the senior debt. So looking for mezzanine or some pref, right? Or some other, they didn't want to be the full capital stack on the deal. And so there was a lot of interest, but not all the way to the bottom of the capital stack. And so I think that's also a little bit of the change in the propensity for these groups is that they would want to be in the middle of the deal, not at the very end of it.
yeah.
Um,
Why not just take them in the middle?
Well, a couple reasons. One, when we bring on our investors into the bottom of the deal, it really puts more risk into them because you're not spreading out the return over all the equity investors. You first have to satisfy that preferred equity group in the middle before it trickles down, right? So it has farther to fall, more waterfalls to go down before the money lands on us.
Right.
And preferred, another way of thinking about this, going back to the first part of our conversation, is having this preferred equity in there is like artificial leverage, right? Instead of a group, you have your senior debt at 5 or 6 or 7%, and this preferred group needs 10, 12, 13, 14%. And it acts as leverage, right? And so
Yeah.
by the time you get to the very bottom of the group, there might be a lot of money or nothing. And so it is a way of sort of artificially creating leverage in the deal. And they might sound smart and it sounds like preferred equity and you get institutional dollars, but to the regular investors that participate at the very end of the capital stack, it's just a lot more. It's a lot more risk that they may not fully understand, and we're not willing to put our investors behind multiple groups and
Yeah.
expose them to that kind of risk.
Yeah, you might have the potential of getting higher returns with something like that. But again, it's even greater the amount you talk about levered versus non-levered. Now we're looking at 85, 90% truly loan to
Mhm.
value. If you're now you're in that really small and it helps boost your returns, maybe as long
If
as
you're right.
everything works out.
Yep.
Right. If there's money left over, now your returns might be boosted. But
Correct.
that's
Yep.
if money's left over. Well,
Correct.
Drew, anything else on the debt market and how it relates to acquisitions that you want to hit on?
Yeah, I think there's a lot still coming on in terms of how the new administration comes in Washington, D.C. There's going to be some new Fed appointments, right? And so I think as we get into the 2025, there'll be a lot of things to sort of keep track of, right? What the Fed does if they keep unwinding their balance sheet and that puts pressure on interest rates. So I would say that as much as we like to think we're just buying real estate, we're really buying into a larger macroeconomic environment. So I encourage investors to learn what's happening, ask us questions, right? Help us, spend time trying to understand the things that move the global markets, right? And that's something that at Endurance Capital we try to spend our time being very thoughtful of and aware of, and sort of talking about and assessing. So I think just keep an eye on things in 2025, and we'll look forward to putting together the best deals we can.
Yeah, 2025, it'll be an interesting year to see what changes, what stays the same with the administration changeover, how that affects really the overall environment. What kind of influence do they have on the Fed if they have any? They're not supposed to have any influence. Of course, we all know that's not true.
That's
Uh,
right.
but yeah, one thing I thought was interesting as we worked through these last two loans, as the lenders have really kind of been more scrutinizing, making sure all the I's are dotted, all the T's are crossed. We got the deals done and it went relatively smoothly, but they just wanted more information than they ever wanted before, just little stuff.
Yep.
So it's interesting. They're paying more attention. I feel like investors are paying more attention. Overall, actually, I think it's a good thing. Like everybody
Right.
should be paying more attention. And so I think that's affecting the market as well, too.
Mhm.
Everybody's starting to pay attention, um, which ultimately leads to better deals. At least it should. It should lead to
Yep.
better deals. So.
Yep. That's right.
All right. Well, Drew, again, really appreciate you being on the show, and you have a fantastic rest of the day.
Great. Thanks, Todd.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.